Hello traders, this is the next episode of my trading mentorship, and in this video we will cover what are new week opening gaps and what are new day opening gaps in futures market, and then we will also talk about position sizing. Okay, when we were saying in the previous videos, in the risk management video, that if we wanted to risk $100 and I explained it in theory, now we will see what it looks like on the chart, what are these long position, short position, how to actually calculate the contracts, how much contracts you should enter with. So it will be very good and practical video for you, for beginners, to understand how to actually enter a trade and how to manage your position. Okay, so let's start. First of all, let's start understanding in futures market what are new week opening gaps and what are new day opening gaps. So first of all, what you should know about futures market. Okay, futures market is opened from Monday to Friday. On the weekend, market is closed and we only have 5 trading days in the week. But these trading days from Monday to Friday are not 24-hour market. Okay, it is actually 23-hour market. So in futures, like if you check like crypto market and forex market, it is actually 24-hour market. But the futures market, and especially the NASDAQ and all the futures market, are 23-hour market. Okay, I mean NASDAQ and SP 500 futures indices market is 23-hour, not 24-hour. So now let's understand what are the new week opening gaps and what are the new day opening gaps. Let's start with new week opening gaps. What did I say? Let's take example on this chart. Okay, you are seeing this, so I am on daily time frame. I assume you already watched the previous videos and you already know what are the time frames. So we are on daily time frame. Look at this. This is Friday. Okay, from Friday, what comes next? It comes Monday. Why? Because from Friday, then it is the weekend. Market closes on Friday and it opens on Monday, right? So market is closed on the weekend. So what do we see here? You know how the candle, what candles show us, right? From the previous videos. Price, the week closed here on Friday, and then the week opened here on Monday. Okay. What do you see strange about this? Okay. So market closed above here, and then market on the next week opened here. This difference here is called the new week opening gap. So this is daily time frame, and if we drop on 1 hour time frame, it will be more clear why it is called the gap. Okay, so look at this here. Market closed here. This is the 1 hour time frame. Market closed here. This is close on Friday where market closed, and this is Monday where market opened. You see this gap, whatever we have here, this huge jump. Okay, we have empty space. This is called the gap. Okay, so here, so from the close of the Friday and from the open of Monday, it is called new week opening gap, and you will simply mark the new week opening gaps with this box. You see the rectangle here, so you go here, then you click on rectangle, you click on magnet, and then you simply mark from close to open, okay, on Monday, and this is called new week opening gap. Here, wait a second, new week opening gap. I will later in the video I will explain how these new week opening gaps and new day opening gaps are being used and how you can take advantage of this and what are these actually. But for now, let's explain it in theory. Okay, this is how it's marked from close on Friday to open of Monday. This is new week opening gap. And now let's understand what is new day opening gap. Okay, we can take any day. Okay, so as I am saying, market is 23 hours on each day, right? So let's take this example here. This is close of 16th of July. Okay, here market closed. Then on 17th, where did market open? Market opened here. You see the difference from the close to open. So this is how you mark from close of the day to the open of new day. This is called new day opening gap. Okay, let's take one more example. Let's take this example here. You see the close of the 22 of July. From this close to the open of 23 of July, this is called new day opening gap. So these gaps are formed because market is opened only 23 hours, and in like 1 hour market is closed, and no one knows, like most of the time in that 1 hour market actually drops or increases in price, which is causing on charts the gaps. Okay, and these gaps are very, very useful, and I will explain why and how these gaps are useful. Okay, so in the previous video I'm mentioning a lot about point of interest, right? The point of interest for buys, point of interest for sells. Okay, so new week opening gaps and new day opening gaps can be used both for point of interest for buys as well as point of interest for sells. It all depends on your analysis. Are you bearish? Are you bullish? What is your narrative? And where price and where these new week opening gaps and new day gaps are located. Okay, I will give you a bit of examples now. Okay, let's mark it out. Also, what you should know, new day, like when the week opens. Okay, let's take example on the previous week. Okay, here. Why do I have this mark? This is called new week opening gap. Why? Because here, this is where market closed on Friday. This is where market opened on Monday. Okay, so this is called the new week opening gap right here. Okay, so on the chart you can have like previous like 3 weeks of new week opening gaps, which is more than enough. So you don't need to mark like here what happened and what new week opening gaps we had like 2 months ago, 3 months ago, 4 months ago. You just need the previous ones, okay, the current ones, like maybe previous 3 new week opening gaps that you can mark out and have it on your chart. Okay, here this is also one new week opening gap, so you simply have it on your chart because these are useful and these are this can give you very, very good informations. Okay, and so what I said, you can mark 3 current new week opening gaps, and you can mark like 5 current new day opening gaps. Okay, what does this mean? This means that new day opening gaps are a lot right here. Like we have a lot of new day opening gaps, but you need only the current ones, maybe current 5 that you can mark out on your chart and pay attention. Okay, so now let's start understanding how we can use new week opening gaps and new day opening gaps in our advantage. Okay, so what we know now is premium discount, right? And now we also know the point of interest, new week opening gap, new day opening gap. Based on only this, let's start understanding how we could take trades previous week. Okay, so let's start understanding. We have marked our new week opening gap here. Now let's mark out where do we have new day opening gaps. So you see this Monday 13 of July. This is 14 of July. What do we see here? Market closed here, market opened here. What is this? This is new day opening gap. Now let's drop on, let's say 1 hour chart. Okay, let's drop on 1 hour chart or maybe 4 hour chart. It does not really matter. So look at this, guys. So look at this. So this is new day opening gap. Let's say that this is daily point of interest. Okay, market turned from bullish to bearish, right? Here we shifted from bullish to bearish, and now what is this? This is lower low. You know the market structure already. This is lower low. Oh, I'm sorry. This is lower low, and this is lower high, right? This is lower high. What did I just mention? When market is bearish, okay, when market is bearish, what do? You simply mark out your Fibonacci tool from the lower high to lower low, and what do you wait for? You wait for retracement, the pullback, where we are waiting for pullback above 0.5 Fibonacci level. Why? Because this is the premium. And then what did I mention? We need to find some kind of point of interest for sales in premium. Pay attention to the new day opening gap that we just marked. Where is the new day opening gap located? It is located above 0.5 Fibonacci level, which is the discount, premium, okay, above 0.5, this is premium. And look at the rejection, okay? Price is rejecting from this area. And now if we drop on 1 hour time frame, what do we see? Okay, price gave us displacement downside. I know that you don't really know these terms that I'm using, the displacement, the fair value gaps yet, but all I'm saying is that Price met the new day opening gap, which was the point of interest for sales, and it was point of interest for sales because market was bearish and price retraced into the premium, and in premium we had this new day opening gap which could be used for our point of interest for sales. Okay, we have displacement downside. Once price retrace into the new day opening gap, we could take short position and we would win this beautiful trade right here. Okay, let's take another example. Okay, let's take another example. Then let's watch what happened. Okay, we have marked new week opening gap here, right? If you check on the chart, this is this week's new week opening gap. Okay, what happened previous week? We have marked our new week opening gap. Price is obviously bearish because what is market structure? Lower high, lower low. Now what was the lower high and lower low? This was lower high and this was the lower low right here. What would we do this week? Okay, we would mark our Fibonacci tool. This is just from the knowledge that you have. Okay, I am using a lot more confluences and I don't actually trade like this. I'm just giving you practical example why this can be useful. Okay, what do we see? We have lower high, lower low. Price retraces above 0.5 Fibonacci level, where we have what? New week opening gap located in the premium range. Okay, this is premium. What do we see? Then we would drop simply on, like this is for our point of interest right here, what we have, the fair value gap. We will drop on 15-minute chart. I think you already know that from 4 hour, you are simply looking for 15-minute confirmation. And what do we see? From the new week opening gap, which was point of interest for sales, we have displacement downside. Once price retrace into this fair value gap, we could execute shorts and we could target the session lows. Okay, I know that you maybe do not understand this stuff, but all I'm saying is that these new week opening gaps and new day opening gaps can be used as point of interest. Okay, both for sales and buys. It just depends on the market condition. Okay, is price bullish, is price bearish, and it depends on your narrative and bias for the day. All right, this was what you should know about new week and new day opening gaps, how it actually looks like marking out on charts. And now let's move on to understanding about position sizing. Okay, what is position sizing? So in the risk management video, I was saying that let's say you are risking $100 and I know that you are risking $100, but whatever you are risking, maybe you are risking $100, compared to the risk, your reward is bigger. What does this mean? This means that if we are risking $100, our reward should be more than 2. Okay, so when I'm taking trades, the risk to reward is 3, it is 4, it is 5. So let's say, let's take example of this trade. Okay, I showed you that I would take this beautiful trade. Let's say we are taking this trade. Okay, so first of all, what is this tool? Okay, you simply go here. When you want to short the market and when you want to take short position, you simply tap into the short position. This is the entry, and we also have stop loss and profit target. Okay, the red is the stop loss and the green is the profit target. Okay, so now let's understand what is this. Okay, first of all, what you should pay attention to. Okay, what do you see? You see that stop loss size here, whatever is in the red, compared to the green, is a lot smaller, right? This is very, very good for us. Okay, our job is that our stop loss should be lower and smaller, and our profit target should be higher, so our risk to reward is bigger. Here 4.76, this is where risk to reward is written. Okay, what does this mean? This means that if we took a trade here and if we entered here, okay, and if we had our stop loss here and our profit target here, our risk to reward would be 4.76. What does this mean? This means that if we risk $100, how much would we win? We would win what? 100 times 4.76. So our profit would be $476. Okay, which is very, very good. We are only risking 100 in order for us to win over $400, and I think it is very, very good risk to reward. Okay, now let's understand that we are saying, okay, now we are saying that we want to risk $100, right? Like so this is Top Step platform, and all the platforms will be very, very similar here. So here you can write we will, in this video, we'll talk about the micro. Okay, so if we want to go on SP 500 chart on the platform, we will write MES, and it also says here micro SP 500. And if you want to load the Nasdaq chart, we will write MNQ, which will be micro Nasdaq. So now let's understand what are what are the contracts, okay, and how we should calculate the position size. Okay, so when we are entering a trade, we are not saying, and we are not writing here risk $100, okay, or something like that. We are not writing anything. So we are writing number of contracts. So we are trading the futures market with contracts, and we have to open a trade with a number of contracts. Here, do you see this? This is number of contracts here. It can be 1, 2, 3, 13, okay, it doesn't matter, okay, the number of contracts, it is up to you how many contracts you are entering a trade. Now let's understand, like if we want to risk $100, how much contracts should we enter with? Okay, that's the main question, and that's, now let's understand how that is calculated. Okay, so first of all, what should we do? It is different, like it is minor difference between SP 500 and Nasdaq, how it is calculated. But first, let's understand on SP 500 how the contract size is calculated. Let's say we wanted to risk in this trade $100, okay, $100. You see the points here, the red here, it says 10 above it says 10. This means this is size of the stop loss. Size of the stop loss is 10 points. So this is a steps how to calculate. First, you multiply the size of stop loss by 5. Let's write here, multiply, okay? First of all, whatever will be your stop loss size, and also what is, first of all, let's understand what is stop loss. Stop loss, what stop loss really means is that if price goes up here, you will lose the trade. What does this mean? Whatever you were risking, when you enter a trade here and price goes up above your stop loss, wherever you have rested your stop loss, if price goes up, then you are losing whatever you risked. In this case, we are taking example on $100. If we risk $100 and price went up here, you would lose the trade, which means that you would lose $100. Now let's understand how much contracts should we enter with. So first of all, what do? We check what is the points of our stop loss. It is 10 in this case, okay? So first of all, we multiply size of stop loss by 5, which is what? 10 times 5 is $50, okay? So what does $50 mean? $50 in this case on SP 500 means, let's write here, SP 500, okay? On SP 500, this means that if we entered here with one contract, we would simply risk $50, okay? So here, if I write it one contract and I press sell one when price was here, I would simply risk $50 if my stop loss was here, 10 points. And now, based on this, you would calculate how much contracts you want to enter with. So with one contract, so let's write, almost $50 is amount I am risking with entering one contract. So take notes, okay? Take notes. So $50 is the amount I am risking with entering one contract. So if I wanted to risk $100, how much contracts would I enter with? With one contract, I am risking 50. If I want to risk $100, I would simply go in with two contracts, because $50 plus $50 will be 100. Okay? Simple as that. Now let's take another example, okay? So I think you understand this, so take notes on this, and I will also tell you what is the difference on Nasdaq. If we are, let's copy this, and okay, let's copy this. What is the difference about Nasdaq? On Nasdaq, the difference is that multiply size of stop loss is not by 5, it is by 2. Which means that here, instead of 50, it will be 20. So if this chart was Nasdaq and Nasdaq's stop loss size was 10 points, what would we do? We would not multiply by 5. On Nasdaq chart, we would multiply by 2. So it would mean that $20 here, $20 is the amount I am risking with entering one contract. So if you wanted to take short on NASDAQ and risk $100, how much contracts would I enter with? I would enter with 5 contracts. Okay, why would I enter with 5 contracts? Because with one contract I am risking 20. So if I want to risk $100, I would enter with 5 contracts, because 5 times 20 is 100, and this is what I need. So what you should understand and what you should pay attention is that when you are entering a trade, you have to specify how much contracts are you buying or selling with, and based on the stop loss size, you simply calculate how much contracts you want to risk. Okay, and it is a bit slightly different about SP 500 and NASDAQ. Now let's take one more example. The short that I mentioned earlier on the new week opening gap and new day opening gap. Let's take this example here. We had our new day opening gap. Okay, we had displacement downside, price retraces into the new day opening gap here, exactly at the new day opening gap. We take a short. It is also 10 points. Let's do another example. Let's take example of buys. Okay, let's take this example. Let's say we want to long. We want to long here, and we are targeting the new week opening gap. Okay, let's say we are longing here, and we are targeted new week opening gap. Let's say in this trade, okay, let's say in this trade I wanted to risk, I don't know, like $200. Okay, let's say I wanted to risk $200 in this trade, in this buy position trade. How much contracts should I enter with SP 500? Okay, let's say I am taking trade and my stop loss is 20 points. What did I just mention? How would you risk $200? First of all, what you should do, our stop loss size is 20 points. First of all, on SP 500, you multiply 20 by 5, which is what? 100. Okay, what does $100 mean? $100 means what amount of money you are risking if you entered with one contract. Okay, so we are risking $100 by entering one contract on SP 500. If I wanted to risk $200, what would I do? I would simply enter with 2 contracts, because 2 times 100 is $200, as that's the risk I want to take. And what does this stop loss mean? It means that if price came here downside, and if price went below my stop loss, where I had my stop loss, I would risk $200. But if I win this trade, the risk to reward is 2.3. What does this mean? I am risking $200. I can lose 200, but if I'm winning, I am winning 200 times my risk to reward, which is 2.3. Okay, which is over $400. Okay, so this is the scenario on SP 500. Now let's say this was NASDAQ. Let's actually go on NASDAQ chart. Okay, and let's take example of the buys. Let's say here I wanted to buy here on this fair value gap, which you have no clue what is the fair value gap. Let's say like this. I wanted to take this trade and I wanted to target this. Okay, something like this. Let's say we entered trade like this. Okay, so let's say on this trade I want to risk $300 on NASDAQ. How? So my question to you is, how many contracts would you enter this trade with? So on this trade I want to enter here, I want to have my stop loss here, and I want to risk $300. Okay, I want to risk $300. How much contract would you enter with? Would you enter with 1, 2, 3? So for practice, just calculate it on your own, and then continue the video and see if you were right. Okay, so now let's calculate. What did I say? What is our stop loss size? Our stop loss size is 50. Okay, let's do it on 50. Okay, let's say it's 50.50, but let's say it's 50, right? So our stop loss size is 50. What did I say on NASDAQ? Your stop loss size should be multiplied by 2, which is what? $100. What does $100 means? $100 means that if I enter with one contract here, I would risk what? $100. Then if I wanted to risk $300, how much contracts will I enter with? I will enter with 3 contracts, because 3 times 100 is $300. Here is $300. All right, so I would enter with 3 contracts if I wanted to risk $300. All right, and also one more thing, pay attention to the risk to reward. It is a 9.5. So what does risk to reward mean? You are risking 300, but you are, if price goes to full take profit right here, you would win 300 times 9.5, which is a lot of money. Okay, so yeah, this is everything you needed to know about position sizing. This is how it is calculated. The only difference about NASDAQ and SP 500 is that if you enter on NASDAQ, you simply multiply the stop loss size by 2. And if you are entering on SP 500, you simply multiply the stop loss size by 5. That's the only thing. And whatever is the amount of money, that's the amount of money you are risking by entering with 1 contract. And then you can calculate how much contracts you are about to risk. Okay? Thank you guys for listening. I think this video was very, very detailed, and that's everything you need to know about new day opening gaps, how it is marked. New week opening gaps are just point of interest, and you will learn how to use it on your advantage. And yeah, this is about position sizing. And from the next videos and lectures, we will understand like all the point of interest I am using, the fair value gaps, breaker blocks, order blocks, like inversion fair value gaps, like a lot of stuff. Okay, everything that I'm using. So yeah, stay patient, appreciate everything that I'm doing for you. Just like, subscribe, write some comments if you enjoy this type of videos, and see you in the next one. Have a great day, guys.